Welcome back to the Exchange. Retail earnings season is just wrapping up, giving us some more insight into the health of the consumer. Among the retailers we heard from were warehouse giant Costco, hitting an all-time high again today after beating on all key metrics last week. And my next guest says there's still more room to run. She raised her price target $50 to $8.90. For more on that stock and how to position more broadly in retail, Laura Champine is here. She's senior consumer analyst at Loop Capital Markets. Laura, it's great to have you back. Welcome.
Thanks, Kelly. Thanks for having me.
I went back and looked up you know what I'm going to talk about, the Home Depot call, which I thought it was one of the great calls. You made that call on October 8th of 2021. The stock, okay, it maybe had a blow off top of 10% higher, but when you downgraded it back then, you absolutely nailed the inflection point, and now here we are at 328. So before asking you about that, I guess I would ask you more broadly, what kind of inflection point, if any, do you think we're at with the consumer right now?
You know, the consumer is holding up okay. It's a slow growth economy from the consumer perspective. And as you point out, I cover the Home Depots and the Costcos of the world, but also Burlington, Ross. The more discretionary a category is, the more it's under pressure. But best-in-class retailers always do well. It's part of our call on Costco.
Okay, so Costco, why 10% upside? Why not more at this point? Just the valuation? I mean, it's it's probably one of the most expensive real deal stocks in the market.
It's a good point, and I would expect we've been stepping up our price target on Costco for almost 20 years. So I think that this 890 is on the way to a 920, but they do have to earn their way up. We think that this is a consistently great performer in a variety of macro environments, in part because most of their income and cash flows comes from their membership fees. So as long as people see value in the membership, Costco stock works.
Yeah, which is kind of to the point. You know, why not raise the price target more? But here's the thing that's tough about Costco is all investors know. It's worked for 20 years. It's been expensive, you correct me if I'm wrong, for 20 years. It's been a crowded long for, 20 years. And yet, is there any reason to pile out of it?
Couple of reasons to pile in. So new CEO Ron Vaccaris has been there a long time, but a little more intriguing to those of us who've covered this one for decades. Gary Millerchip, who just joined after a 16-year career at Kroger, brings that rare sort of outsider insight, and his specialty is more on using consumer data. No company has consumer data that's as valuable or as complete as Costco because you give them their membership card every time you make a purchase. So his ability to do some sort of new economy things like monetize their retail media network could add to this. That new CEO, Ron Vaccaris, although he's been there a long time, has been a little more public at saying that their margins could move higher. So I look at next year, I'm $2.50 ahead of consensus for EPS. That's assuming they add $1.5 billion on SG&A expenses. I think I'm probably conservative.
That's really interesting. And now that we know from reports in the Journal and elsewhere that a lot of advertising dollars are literally shifting straight to retail and away from other traditional platforms, you have to imagine if they have that benefit of all that card holder data, that's absolutely could be a gold mine. Okay, so putting Costco to the side then, do you expect some kind of broader slowdown with the consumer? And sort of where else are you quite confident in your coverage universe, and where are you a little more hesitant?
You know, we've seen it. I cover big ticket spending, so I follow Whirlpool and Appliances, Mohawk and Flooring, Tempur Sealy and Bedding, and all those companies have seen double-digit declines in units for several years now. So really, if you look back, even at the Home Depot and Lowe's, their 2-year comps, they haven't done this badly since we were coming out of the 2009 downturn. So we're more likely to see an inflection point higher. We need the Fed to play along. So it would be lovely if interest rates would be cut. But we don't expect things to get terribly worse from here because those big ticket categories that are interest rate sensitive have already been really impacted.
That's really interesting. Laura, you always have a different spin on it. Love checking in with you. Thank you so much for your time.
Thanks, Kelly. Have a good day.
Laura Champine with Loop.